mergers and acquisitions. It's a great way for businesses to expand their footprint or jumpstart growth into adjacent business lines or territories. But sometimes it doesn't go perfectly. And in this video, we're going to run through the mega deals gone wrong, the super destroyers of shareholder value. Ready? Let's get into it. If you're talking about big blowups, this almost always has to be on the list, since it has it all. Buying at the top of the market, managers rushing into a new industry they don't fully understand, and just the scale alone is mind-blowing. Generally considered a merger, the deal was technically an acquisition by AOL. And if one image can encapsulate the insanity that was the dot-com bubble, it's probably that the company with revenue on the left bought the company on the right. All told, ownership was split about 55-45 in favor of AOL shareholders. This wasn't hostile though. Time Warner had been on an acquisition rampage, trying to become the 800-pound gorilla of media, and considered the AOL deal as a way to push its world-class content through the newfangled pipes of the internet that AOL seemed to be the dominant player in. The deal stands out for its epically bad timing, being announced within minutes of the tech bubble bursting. But beyond that, management just really had no clue what to do here, as it became clear fast that legacy media and content plus internet doesn't automatically make for profits. They did theoretically have the tools for a pre-Netflix Netflix, but never made it that far. Instead, they got internal fiefdoms refusing to collaborate with their new corporate brethren, and the chunky fees in AOL's core businesses, like advertising, basically vanished. So bad was it that in 2002, 1 year after the deal had closed, the newco reported a massive write-down of goodwill that led to the company reporting a $99 billion loss. And the stock, once worth $226 billion, sunk to below $50 billion. The Greek tragedy finally ended when AOL was bought by Verizon in 2015 for a paltry $4.4 billion. Next, before Microsoft got its stuff together, they basically had this fun period of time where they tried to do everything that Apple was doing, only 4 years late and with lower quality, engineering, aesthetics, you get the point. Everyone remembers the Zune, but the biggest oopsie they made had to be acquiring Nokia's cell phone business. The $7.2 billion deal brought with it 25,000 Nokia employees and a handset market share that was shrinking by the second. The deal was masterminded by then CEO Steve Ballmer.
Ladies and gentlemen, Steve Ballmer!
Yeah, this guy? So a year later, when Satya Nadella took over, he could see that this was a dog with fleas and started cutting. First came a $7.6 billion chop in 2015, and another $950 million one in 2016. I think nothing is more emblematic of the Steve Ballmer era at Microsoft than $8.6 billion in write-offs from a $7.2 billion deal. God, this guy is a goldmine. In the previous AOL TimeWarner case study, we learned that culture matters, albeit maybe not as much as buying at the peak of a bubble. AOL tech guys mixing with Time Warner's legacy media guys was a culture clash, and they created nothing as a result. So, you can guess what happens when you mixed methodical, precision-oriented German engineers with creative and unstructured minivan salesmen from Motor City. Sprinkle in a nice language barrier and 4,000 miles between headquarters, and you can see where this is going. The deal, again a merger, but seeing Benz basically running the show, was announced in May 1998 and totaled $46 billion, making it the largest acquisition of an American company by a foreign buyer ever. The deal was supposed to be win-win for everyone. Coming at a time when major car brands were all touting their premium brands, the idea was for Daimler to become the Lexus to Chrysler's Toyota. Benz would get a stronger entry into the US market and a distribution network. Chrysler would benefit from technology transfer and manufacturing best practices. That was the plan, at least. In no time at all after closing, the teams from Daimler and Chrysler couldn't see eye to eye on anything, disagreeing on everything from marketing to technology to strategy. The grand plans that served as the basis for the merger never found their way to getting implemented in earnest, and the companies basically stayed separate entities with minimal synergies resulting. Also, and this is me speculating, but this probably served as a big distraction that saw Chrysler falling behind in market trends. For example, at the time, Chrysler was the king of minivans, but was slow to catch the shift into SUVs, which they should have crushed given that they owned Jeep and Dodge. And when they did, however, they went big, literally and figuratively, overdoing it just in time for high oil prices to shift the market away from behemoths. Fast forward 9 years, and this marriage ended in divorce, with Benz essentially paying private equity shop Cerberus to buy Chrysler. The deal headline was that they sold 80% of Chrysler for $7.4 billion, but most of that money went into the business to support losses and employee benefits, and Daimler ended up being out of pocket a few $100 million just to get rid of the thing. And a year after that, Chrysler needed a $4 billion bailout from the US government. $46 billion gone. On the bright side, Benz seemed to have learned their lesson, never going so big or so American ever again. Sears. This one's sad, really. Business 101 is all about scale. Get big, get economies of scale, outprice your competitors, and make all the money. Simple. But what if you're already really big? Does getting even bigger help that much? And is it worth the headaches and distraction of integration when you could be focusing on, being a better company? In the case study of Sears and Kmart,
No, God! No, God, please, no! No!
On November 2003, Kmart announced that it would be acquiring Sears for $11 billion as soon as, it got clear of its own bankruptcy. Manager pro tip, don't get acquired by bankrupt companies. Anyway, Sears spent the 80s and 90s doing all sorts of wild things, buying stock brokerages, real estate companies, telecommunications businesses, launching Discover Card, okay, that was kind of clever, buying automotive retailers, you get it. The whole time, Walmart was, getting better at retailing. The early 2000s found Sears on the back foot as far as logistics, procurement, market trends, basically everything they should have been doing instead of playing conglomerate. So, to turn things around, management made the tough decision to right-size the business, invest in technology, redesign the customer experience, modernize the warehousing, and prepare themselves for the shift to online. Psych, they didn't do any of that, and thought merging with bankrupt Kmart would solve everything. Spoiler, it didn't. And it's just sad, really. Sears was one of the great American success stories, and the world's first everything store. Amazon for the vacuum tube age. I mean, they sold cars, houses, and okay, this probably isn't cool anymore, but they innovated and changed the world. This dumpster fire came to an end on October 2018, when a skeletal Sears finally filed for bankruptcy ahead of a $134 million debt payment it just couldn't afford. Rest in peace, Sears. Now, so far, most of these tales have revolved around a few fixed themes. Terrible execution, culture clashes, overly ambitious strategies, etc. This one is different. Fraud. In 2011, HP tried to jumpstart its expansion into the fast-growing data analytics space by acquiring British company Autonomy for $11.1 billion. A steep price tag, but the company had a lot going for it. Roughly $1 billion in 2010 revenue, years of double-digit growth, and mid-40s operating margins. Not too shabby. The only problem was that it was mostly fictitious. Within little more than a year since its purchase, HP wrote down $8.8 billion of the transaction. Lawsuits, SEC investigations, and criminal trials began, with HP citing Autonomy used accounting improprieties, misrepresentations, and disclosure failures to inflate the underlying financial metrics of the company. Ouchie. Fast forward a decade, and the fallout is still hitting the Autonomy management. Several senior managers had to forfeit bonuses associated with the deal. The former chief financial officer, Shashovan Hussain, is doing a nickel in US federal prison in order to pay $10 million in fines after being found guilty of 11 counts of wire fraud, securities fraud, and conspiracy. And in January of this year, after years of back and forth, the CEO, Mike Lynch, has been found guilty in the biggest civil fraud trial case in UK history and is awaiting extradition to the US for likely several more years of fun. HP has been out for blood. Puts all that off-brand printering stuff into greater context. Alright, so that's all I got for today. I hope you enjoyed it, and if you did, please give this video a like and consider subscribing for more informative and hopefully entertaining financial content. I'm Ryan, and thanks for tuning into Market Lab.